Hey everyone, welcome back to the channel, your number one source for income-oriented investing, and it's time for the monthly series where we will go over the income landscape, go over all the top high-yield income-oriented ETFs on the US market. So this is the episode for all US listed funds. It's great to be back in Panama. I had a blast in New York City. In case you didn't know, I was invited to a Yield Max event at the New York Stock Exchange. It was absolutely incredible. I met Jay and a bunch of people from Tidal as well. At that event. It was awesome. Participated on a panel. If you're interested in checking out how our adventure was in New York City, including a bunch of pictures, the event, the closing bell ceremony, etc., check out our Instagram. Make sure you follow us, passive_income_investing. I'll just show you real quick here. So I got a bunch of pictures in the stock exchange. It was a crazy experience. I even managed to find and meet the very popular Mr. Einstein, one of the most popular traders who still is at the New York Stock Exchange. Here's the closing bell ceremony. I just got a bunch of pictures. It was really cool. We also went to the 911 Memorial Museum, which was very interesting. We took a tour of the New York City Mafia hotspots, which was really cool. Obviously, we got some great pictures here near the Bull. Some really nice night shots of the New York Stock Exchange. Check out this picture. Really awesome. There I am next to the girl who's not afraid. So yeah, it was an overall pretty cool experience. There was of course also the first Blossom event in New York City. So here I am with some fellow influencers here. It was just a great time, great 12-day trip. But we are back. We are back in Panama and it's back to business. So as usual, we will check out what the US markets have done in the last month. And needless to say, they are on fire in the last 30 days. The S&P 500, which is the best indicator of the overall US market, is up almost 4% in the last 1 month, which is absolutely incredible. Completely destroying the Canadian market, by the way. The NASDAQ even more so, up 7% here in the last 30 days. And by the way, just for reference, I am filming this on July 5th. So now let's go over the income landscape. We'll start, of course, with ETFs with a special focus on the index or more diversified ETFs. And then we'll go into the more niche stuff, the fixed income stuff as well. So first, I'd like to thank the sponsor of this video, very good friend of the channel, Covered ETFs. So I just saw this here on their page. I'm very excited about this, although it doesn't look like an income-oriented ETF just from the title, but they are about to launch a new ETF, QQQ, the Curve Technology Titans Select ETF. My guess is that this is going to be more of a growth-oriented ETF, specializing or specifically for technology stocks. So this could be an alternative to a NASDAQ 100 in case you want pure technology exposure in a growth style, whereas something like a FEPI would be the income style, but I'm not 100% sure. We'll have to see. And also don't forget that they have the Curve Yield Premium Strategy ETFs. They have an Amazon, Apple, Google, Microsoft, Netflix, Tesla one, which basically these ETFs invest in these stocks or the stock prices of these stocks, but they're writing covered calls. So it's actually very similar to what Yield Max does. Except they do less covered calls, right? They're less aggressive with their covered calls, so you could gain more upside if, for example, Amazon or Apple or Google go up. So very similar, but a little bit more upside potential, I believe. It's less capped than the Yield Max ETF. So make sure to check it out if you're interested. If you're an income investor and you want to invest in Microsoft or Apple and Google and you want yield, these could be great to consider for your portfolio. So moving on to the overall landscape here. And we'll focus first, of course, with the index-based diversified covered call ETFs, which pretty much on the US market, they're all index-based. S&P 500, NASDAQ 100, and a couple of Russell 2000. So, of course, we'll start with QYLD, the OG. This is just a rinse and repeat strategy, guys, so I'm not going to have much to comment on this. ETF, there's really no changes because it's just a rinse and repeat, but the last distribution has been decent at 16.8. Volatility is pretty low. You could see that here. They're not even making 2%. In May here. This is the last one that's been updated. June is not here yet, I guess, but it's going to be a little bit higher than May. I believe a little bit higher volatility because, it's right here, because the distribution is a little bit higher this month here. So moving on now to JEPI and JEPQ, the OGs or the biggest, not the OG, that's QYLD, but the biggest in terms of AUM index-based covered call ETFs on the US market. So JEPI released a new distribution, a little bit less than last month's at 33 cents. So remember with JEPI, it's not the entire S&P 500, it's defensive. It's kind of like a defensive play on the S&P 500. So like Mr. Hamilton Rayner said, the expected yield you're going to get is about 7 to 9 with this one. And with JEPQ, same thing, but on the NASDAQ 100, it's a little bit closer to the NASDAQ 100, in my opinion, than JEPI is to the S&P 500. Obviously, the yield's going to be a little bit higher here. You're looking at, if I remember correctly, what Hamilton Rayner said, between 9 and 11%. So it's going to be a little bit higher. And just like JEPI, latest distribution, a tiny bit less. By the way, JEPQ is just flying with the AUM, guys. I think eventually might even beat JEPI at 15 billion already. Pretty crazy. Moving on to some of its competition. Goldman Sachs, of course, you have GPIX for the S&P 500. You have GPIC for the NASDAQ 100. These ones have been performing very, very well. They have some of the in terms of performance of index-based covered call ETFs, they are second best. I will tell you who's first in a second, but they definitely, GPIX is outperforming JEPI, basically is what I'm saying, and GPIC is outperforming JEPQ. And the reason is really simple. It's because these ones actually have the S&P 500 and NASDAQ 100, whereas JEPI and JEPQ don't. They have some of the stocks in there, or a lot of the stocks in there. So the distributions have been very, very consistent for both of these, by the way. You're looking at about 8% with GPIX yield, and you're looking at about 10% yield with GPIC, obviously, because the NASDAQ is a little bit more volatile. A little bit lower than last month here, than the last month, but still very, very consistent and impressive, not only yields, but performance. Well, not super impressive yield, but we're talking about 8% on the S&P, 10% on the NASDAQ. So these ones are just less, they're covered call ETFs. They don't have a lot of covered calls, right? So you are gaining a lot of the upside of both indexes. And because the S&P and NASDAQ have been on fire, that's why these are performing really, really well. The very popular next, SPY-I and QQQI, a little bit more yield here, a lot more yield actually, but you're capping more of your upside. And this is why, if you compare the total return of GPIX to SPY-I, GPIX is beating it. But SPY-I does have very, very consistent monthly distributions, a very consistent annual yield of about 12%, which is about 1% a month here. It's getting very, very, very popular, by the way. 1.5, almost at 1.6 billion in assets. So a lot of people love the very, very consistent distributions. I don't blame them. They do have QQQI, which is a NASDAQ one, very similar to SPY-I, same thing, same strategy, same fee, but it is on the NASDAQ. And look at this yield, almost 14.5. Also with very, very nice, consistent monthly distribution. So these two are really, and by the way, guys, just for context, I am planning, once all the review videos are out for all the, S&P, NASDAQ, covered call ETFs in the US, because there's just so many, I'm planning to do a video where I actually compare all the S&P 500 ones, all the NASDAQ 100 ones, and try to give you really the difference between them and which one might be best for you, because they're all investing in the same thing, more or less, right? The indexes. But it's really a matter of the strategy being a little bit different. Some write more covered calls, you'll get more yield, but you'll get less upside. Some write less covered calls, you'll get less yield, but you get more upside. So it's really a matter of figuring out which one is best for you. Because I really feel as an income investor, the foundation core of your portfolio should be an S&P 500 NASDAQ 100 ETF. So QQQI, definitely a good one here for the NASDAQ. Moving on, BlackRock. BlackRock's in the game now. You have Bally. Bally is really similar and a competitor to JEPI. So it's not the entire, you see that the management fee is the same. So just like JEPI, it's not the entire S&P 500, but it's stock picking in the S&P 500. And last I checked, it's actually outperforming JEPI by a lot. So if you like JEPI, I strongly suggest you take a look at Bally. You definitely need to know about this one. You can check out the performance. The yield is about the same as JEPI, by the way. It's near the 6, 7, 8% mark with the same fee. In terms of the index ones, you have IVVW, very easy to understand because their S&P 500 ETF is IVV. This is simply IVVW. I just did a video on this one, covering this one, the strategy in detail. This is the lowest fee S&P 500 covered call ETF at 0.25. It's also, just like QYLD, XYLD, RYLD, a rinse and repeat strategy. It's a 1% out of the money monthly call. So This could be great if you like rinse and repeat strategies. You don't mind giving up quite a bit of S&P 500 upside for quite a bit of yield. This one has about a 10 to 12% yield, but you do have to expect varying monthly distributions. The latest one, much bigger than the last one, not as big as the first two, but this is going to vary based on volatility of the S&P 500, but definitely a higher yield, more aggressive covered call strategy. You're basically only capturing 1% of the upside monthly of the S&P 500 when, as of the date they're writing the call. They have the same exact thing on the Russell 2000, except this is a 2% out of the money, so you're capturing a little bit more upside. Very high yield as well on this one. This could be, in my opinion, this is, if you absolutely want a Russell 2000 covered call ETF, this one is by far the best one, in my opinion. Better than RYLD. I also think it's better than the Defiance one because it gives you a lot of room of upside to capture, and it has a extremely, it is the lowest fee Russell 2000 covered call ETF at 39. Of course, it's BlackRock, right? So it's going to be definitely the lowest fee. Moving on, you got QDTE now, starting with the daily ones. QDTE and XDTE from Brownhill. These ones are just chugging along. QDTE had a massive boost in the AUM. I think I have something to do with it. Because I had swapped my SPY-T position in the QDTE, as you saw in last month's unveil. Last week, these are weekly distributions. This is what really makes these unique. They're very, very similar with the Defiance one does, the QQQY and the JEPY. I think they do have a little bit less covered calls, slightly less covered calls, but they do have weekly distributions, which is pretty fun. Weekly compounding. So in terms of the distributions, you got to expect varying distributions every week with these. But I've been pretty impressed with the performance, especially QDTE. This performance has been pretty solid, really close to GPIC as well. I think it's underperforming it a little bit, but remember, the more covered calls you're doing, the more they're going to underperform in a bullish environment. And the NASDAQ definitely has a bullish environment. Where I think these ones and QQQY and JPY will do best or start outperforming is during flat or down market, right? So QQQY, JEPY, these are the highest yield NASDAQ 100, S&P 500 ETFs. We're talking 50% plus yields. Last distribution, for QQQY has been lower, no surprise. Volatility has been much lower here at 65 cents, and JPY at 46 cents. But hey, some pretty decent performance, especially JEPY, who is outperforming SPY-I, by the way. If you just compare them, you use the start date, the correct start date, JEPY is definitely outperforming SPY-I right now, which is very, very cool. And then you have the Russell 2000, which is very, very high yield, 58% right here, based on the last distribution. So again, I am planning to do a video, guys, to compare all of these, so to help you choose which one is best for you. Don't forget, if you're having trouble choosing, you can choose a combination of S&P 500 or NASDAQ 100 ETFs as your core. Stick it out for a year, and then trust me, after a year, you get some experience, you'll know which one is best for you. In terms of strategy, my favorite one by far is the QQQT, which is newer. And SPY-T. So QQQT is the NASDAQ one, SPY-T is the S&P 500 one. I've been very impressed with SPY-T's performance. Really, really top-notch performance. They still use a daily option strategy, but you're capturing a lot more upside because they're basically doing a daily call spread instead of something like QQQY, which just does regular in-the-money put, which is basically covered call, out-of-the-money covered call. So basically with QQQT and SPY-T, if you compare them to JPY and QQQY, you are capturing more upside if the indexes go up, a lot more upside. And also monthly distributions. And another thing that's cool is they actually are target yield. So they both target 20% yield. So this is going to be, much more stable. Obviously, you're going to have less yield than the other ones, but you're capturing more upside. Well, that's generally the rule of thumb, guys, right? It's not rocket science. The lower the yield is, the more upside you're capturing. Last but definitely not least, in terms of the daily ones, you have iSpy and iQQQ from ProShares. And last I checked a few days ago, guys, I compared all of these, the S&P ones, all the NASDAQ ones. These ones are the best performers. So iSpy right now is number one in terms of total return compared to, JEPI, GPIC, SPY-I, Even Bali, IVVW, XDT, you know what I'm saying, right? In terms of the S&P ones, iSpy is the best, and IQQQ, I'm assuming, I think it is as well, but this one's relatively new. So these ones have a lower yield, however, and of course that makes sense. You're looking at about, near the same yields that GPIX and GPIC have, about 8% with iSpy and maybe 8 to 10 with IQQQ. But IQQQ is relatively new. How many distributions have come out? I'm just curious. I think just one or two. No, my bad. Three. So yeah, 35 cents, 29 cents, 35 cents. So what's the yield here? About 10%. Yeah, so you're looking about 10 to 12. So very similar yields to the Goldman Sachs ones, but they are outperforming even with a slightly higher fee of 55 basis points. But in terms of the daily ones compared to Defiance and Roundhill, these are definitely the lowest fee daily option ones you have. So that's it for the index ones. Again, stay tuned for a video. I do want to do a video on these two, and then what I'm going to do is maybe do a video comparing them all to give you an idea to help you figure out which one is best for you. So moving on to the other ETFs, my personal favorite alternative style one, SVOL, which just passed $1 billion AUM. Now it's just a little bit under that, but it was $1 billion last I checked. But either way, we could say this one extremely popular to hit $1 billion AUM. Awesome, super consistent, 15 to 16% yield. No changes here whatsoever. You still have a 30 cent monthly distribution, which translates to about 15.5% yield, something like that, based on the current price. And my plan is to do an SVOL video update. I want to hook up with Silesh again. I want to talk to him about it, see how it's going. I know you guys, would you guys like an update on SVOL and for me to have Silesh, the creator of SVOL, back on the channel to discuss it? Let me know if you're interested, if it'll have value for you. Remember, I'm here to do the content that you guys want to see. Continuing on more to the alternative ones, you have High, also from Simplify. News on this one is they re-increased the distribution back to 20 cents. It was 20, then they lowered it to 16, then 14, then 14. Now it's back at 20. So you do have to expect varying distributions with these ones, and it could happen on SVOL as well. So High is also a really good, safer, alternative style ETF where they just do call spreads basically, and put the rest in T-bills. So it's actually a very conservative ETF here, and you'll get 6 to 8% yield, something like that. Also very big, almost getting to 500 million. And then of course, last but definitely not least here is the Yield Max, who just continue to add more and more ETFs. You have Snowflake and Airbnb was just added, so obvious, and then Gold Producer. So these ones are going to be added to the all-in-one YMAX eventually. You guys already know that my personal favorite one is YMAX because it's simply the all-in-one. It's definitely going to be the most boring one, but the least risky, because everything else is really tied to the underlying stock. So of course you have really boring ones like ExxonMobil, JP Morgan, Microsoft, Apple, but then you got some more volatile stocks, some more crazy ones like Coinbase and Nvidia, where you'll have a lot higher yield, obviously Tesla, but more risky because the risk is always tied to the underlying stock, guys. Don't forget that. So this is why I like YMAX, because it's just an equal weight of all of them. So it's almost as if you're kind of investing like in a little NASDAQ 100 or index fund of the Yield Max ETFs. Really cool. They also started coming out with inverse ones. I think the Coinbase inverse, the Nvidia inverse is coming next. So I've been getting some questions asking, Adrian, what happens if you hold Crash, for example, the Tesla inverse with Tesla? What if you hold 50% Tesla, 50% Crash, to kind of balance out what happens with the stock price and just collect the income? Or what if you get the Coinbase one and the inverse Coinbase one, right? Same type of thing, 50-50. So if it's something that you're interested in understanding, let me know, guys, in the comment section below. I'll invite Jay back on the channel. I'll ask him about just that. Moving on now to the fixed income-oriented ETFs. So yes, there's so many to cover here, and also the niche, the Bitcoin and the more niche sector-specific funds, as well as the closed-end funds. Let's do now. So in terms of a fixed income, if you want kind of like an all-in-one where you have a lot of different types of bonds, I personally think the best option is AGGH from Simplify. So it's basically, when you see AGG, aggregate bond, it pretty much means let me diversify my bond exposure. So you'll typically get some government, some corporate, high yield corporate, investment grade corporate, and other bond crap stuff. So this is kind of like an all-in-one in the fixed income world. And this one also very popular, 200 million, yield of about 8 to 10, something like that. And this one also, dividend was reduced to 14 cents in the last 2 months, but they put it back to 20. So we'll see what happens. So if you really, fixed income is not my thing, I'm not a fan, but if you want to add fixed income to your portfolio and you're an income investor, I think AGGH is a great all-in-one diversified option. Of course, if you want to get some specific exposure, you have TLTW, LQDW, and HYGW from BlackRock. So of course, TLTW is TLT with covered calls. This is specifically long-term U.S. government bonds. LQDW is specifically investment grade or high-quality corporate bonds, which is LQD with covered calls. HYGW, which is by far the best performer out of the three, is high yield corporate bonds, which is also typically referred to as junk bonds. This one's by far, and it does cover calls on HYG. This is by far the best performing one at 5% since inception. The other ones, not so great. TLT, of course, the TLTW, the worst one, because quick interest rate rises, rates that go up put pressure on long-term bonds, long-term government bonds. But I just wanted to show you this, by the way. How is TLTW doing versus TLT? And the covered call when TLTW is doing its job, guys. It's actually outperforming TLT. So, of course, if TLT is having a bad time, the covered call one is going to do better. And this is exactly what you're seeing. You see, since inception, the total return is minus 11.49 with TLTW, and it's minus 12.74 with TLT. So this is exactly what covered calls do. During crappy times, they cushion a downward momentum or downward performance. So I just wanted to point that out to you. But in my opinion, guys, if you really like the BlackRock ones, this is by far the best one. But I really think this is really your all-in-one type option if you want fixed income. Personally, not a fan. Moving on to Bitcoin, which has taken a beating lately for some reason. I still like Maxi, which is basically Bitcoin futures. You'll get a little yield, but you'll get pretty much full exposure to Bitcoin. And this is the YBTC from Roundhill. This is a classic covered call, so you are capping your upside, but you're going to get definitely more downside protection than Maxi and a lot more yield. You could see that the yield has been pretty much incredible here. This one just does covered calls on BITO. That's all it really does. And you can see the distribution history, big distributions. Although the latest one has been smaller, I'm assuming the next one is going to be a little bit higher because volatility must be a bit higher now on Bitcoin. But you're looking at between 20 and 30% yield on this one. But remember, this one gives up more upside if Bitcoin goes up. Moving on to some great sector-specific ETFs. Of course, you have FEPI, very popular. This is basically a technology covered call ETF here with a pretty consistent 25% yield. You're looking at about 15 of the best technology stocks out there. Here's the top 10, all things that you'll probably recognize and you'll expect. They also came out with an AI one, so similar style, similar strategy, I'm assuming. They didn't declare the first dividend. I'm assuming, my guess is going to be between 25% at the minimum and probably higher, maybe 30%, because this one has more AI type stocks. A lot of the same stocks in FEPI, like Nvidia, and you'll get Adobe and Apple and Broadcom, some tech, some chip ones as well, but definitely more to do with AI, more AI focused. It's based on an index, rules-based index that tracks the performance of companies that are at the forefront of AI technology. So guys, let me know if you want me to do an in-depth review of AIPI, but this is basically a dream come true if you want to get into the invest in AI companies. Number one. Number two, you don't want to pick and choose those companies. Number three, you're an income investor. You want covered calls. AIPI is great for the AI play. FEPI is great for the overall technology play, which of course includes AI. Crane Shares has CLIP, which does covered calls on KWEB, the very popular KWEB ETF, which is an index fund that tracks the best Chinese technology companies. So this one is still doing its job. Very, considering KWEB has not had a great time. The average performance here, 5.64. It's definitely destroying KWEBs, right? So this is, again, what covered calls do. If we compare KWEB to CLIP here, you'll see that CLIP, that does 100% covered calls, is absolutely destroying KWEB, of course, because this is the actual ideal time to write covered calls or aggressive covered calls, is during a sideways or range bound market where, you know, you could see KWEB not really doing much, right? So you see what a big difference in performance here since inception. Absolutely incredible. So if you want to get into Chinese tech stocks, you're an income investor, Clip is a great option. Last but not least, guys, we're moving on to closed-end funds here. So you have CLM trading at a 8.3. Let me just refresh, make sure I got the right one. 8.3% premium. So it's at a premium, right? You got to pay $7.70 for something that's worth $7.11. But again, reminder to my Canadian friends watching this, you should not, in my opinion, you should not have CLM, because the best thing of CLM we cannot get as Canadians, dripping it at NAV. Only Americans dripping it should get CLM, in my opinion. You got to make sure it's being dripped at NAV. I know the Fidelity broker does it, but you know, it's not my expertise. Make sure if you have CLM and you're dripping it, make sure you have if you're American and you're watching, you have CLM, I suggest to drip it and make sure your broker is dripping it at the net asset value price. So whenever your dividends get reinvested, you are buying shares at $7.11, not $7.70. It's a humongous advantage and definitely the best part of CLM, which is why I sold it, because I don't get access to that best part. Moving on to my personal favorite all-in-one closed-end fund, it's RIV. This is a closed-end fund that holds a bunch of other closed-end funds. It's still trading at a 3.3% discount. The net asset value is $12.72. So if it's $12.72 by the end of the year, next year's dividend is actually going to go up. It's going to be bigger because it resets at 12.5% of the net asset value. And I believe last year's net asset value reset at $12.50. So now it's at $12.72. So this is leveraged as well. This is why I like it, I think. And it has a lot of fixed income crap. So I think when rates start coming down or start getting cut in the US market, I think RIV is going to do really, really well. But in terms of the highest performing one, it is CEFS. CEFS is an ETF that holds a bunch of other closed-end funds. What absolutely incredible performance. These guys just have good closed-end fund pickers, I guess. And they also, in terms of ETFs, you also have YYY, which is another option, an all-in-one closed-end fund option. And then you have HIPS as well. HIPS is more of an alternative all-in-one, which invests in MLPs, BDCs, REITs, and closed-end funds, which basically sums up the alternative sectors, right? The alternative asset class. And if you like BDCs, you want just BDCs on its own, you know, closed-end funds and REITs and BDCs, you know, they're very high yield. They're a lot bigger, big market on the US. Canada, it's almost non-existent. Specifically for BDCs, what I think is the best option is the VanEck BDC Income ETF, which is a collection of all the BDCs, market cap weighted. As you can see, it's a massive ETF. You'll get about 10% yield, and this is perfect if you don't want to pick and you want to invest in BDCs, but you don't want to pick and choose your own BDCs. So that's it for the American landscape, which is just getting bigger and bigger. I am completely out of breath. My throat is dry, but guys, I'm going to be doing this every single month to make sure that you're updated, that you're always up to date and cover any major news, anything major in the income world, because this will always be your number one source for income-oriented investing. So thanks a lot. See you next time. Hey, don't go yet. A few reminders before you leave. Did you know that I launched a YouTube loyalty membership program where for only $3 a month, you could become a PII Inner Circle member, where you will gain access to exclusive content, exclusive videos and live streams, as well as other perks and benefits, including a really cool weekly opportunity report. That's right. If you're interested, just click on the little join button next to the subscribe button to see what it's all about. Also, make sure to follow me on Blossom and download Blossom. It's a social investing app, which is really cool. You could share your portfolio, follow other people's portfolios, including my own. My username is Adrian_PII. So download it with the referral link below. Not only is it free, but you could actually earn cash by taking these really small, quick 1-minute courses. Really awesome. It's a no-brainer. Also, make sure to visit our website, passiveincomeinvesting.ca. That's where you could book a one-on-one private coaching session with yours truly, with myself, where you could ask me all the questions you want. All the information and booking information is on the website. Make sure to check out that video on the homepage there to see how to book a one-on-one properly. Also on my website, you could purchase my digital product, which I'm very proud of, the Ultimate DIY Investing Package. This is a reference tool or a companion tool that will help you build your own portfolio. So it has lists of funds, it has sample portfolios, and it covers both the Canadian and US stock markets. And the good news is you'll only ever have to buy it once because it comes with free lifetime updates. And my plan is really to update the version every single year. So make sure to pick it up. Also, I have Questrade and PASSIV referral links below. So Questrade is the broker that I personally use, and PASSIV is the broker companion tool or assistant that I use. Really cool program, really cool software. So I have referral links for both of those. Questrade, $50 of free trades, and PASSIV, I have half off for the elite membership. If you're interested in the elite membership, and even if you want to start out with the free membership and upgrade to the elite afterwards, use my referral code so you could still get that 50% off. And don't forget that the elite membership of PASSIV is 100% free if you use Questrade. For social media, we have a very successful and big Facebook group, private Facebook group with over 14,000 members where we all try to help each other out. So make sure to join that group. Information is below. We also have Instagram where you could follow us or more personal stuff when it comes to our life here in Panama. And there's LinkedIn as well. So as usual, everyone, how do I leave you? Continue to stay safe, stay healthy, and of course, stay passive. See you next time.